What if there was a super smart computer that could predict exactly how much money everyone would need each day? Imagine this computer telling you, "Don't worry about your savings, I know no one will ever ask for all their money at once." Now, what if, despite that prediction, every person decided to rush to the bank tomorrow morning and demand every single dollar they own? Would the bank be ready for that? This is the big puzzle. Why can't banks give everyone their money all at the same time? Welcome to Explain Like I'm 5, where we take mind-bending topics and break them down into fun, easy-to-understand stories. Ready to get curious? Let's dive in. To understand this, imagine a giant candy jar. You and your friends each put some candies into the jar, trusting that your sweets are safe. But the person in charge of the jar doesn't just keep all the candies there, they lend some out to other kids who promise to return them later with extra treats. This system works well as long as only a few kids come back to claim their candies at any one time. However, if all of you rush in simultaneously to get every candy back, there wouldn't be enough left in the jar. That's very similar to what happens in a bank when too many people try to withdraw their money at the same time. Banks use a method called fractional reserve banking. Instead of keeping every dollar in a vault, banks only hold a small portion, just enough to cover everyday withdrawals, and lend out the rest. The money lent out helps people buy homes, cars, even start businesses, which in turn grows the economy. The system is built on the assumption that not everyone will need their full deposit at the same time. In normal circumstances, this works perfectly fine, but what happens if everyone decides to get their money back all at once? Imagine a scenario where a rumor starts spreading that the bank might run out of cash. Suddenly, panic sets in and everyone rushes to withdraw their money. This mass panic is known as a bank run. Even if the bank was in great financial shape before the rumor, the sudden spike in withdrawal requests can quickly overwhelm its available cash. The bank was never designed to hold all of its depositors' money as cash. It's meant to use most of it to help the economy by making loans. Trust is the secret ingredient that holds this entire system together. When you deposit money in a bank, you're trusting that the bank will be there to give you your money back when you need it. The bank trusts that you won't demand all of your savings at once. To help ensure this trust, governments have put safeguards in place like deposit insurance. Deposit insurance guarantees that even if a bank fails, you will get back a certain amount of your money. This safety net helps keep people calm and prevents panic. But even with these protections, if enough people lose faith at the same time, a bank run can still occur. Now, think about the role a super smart AI could play in this system. Such an AI could analyze millions of transactions and predict when people are most likely to withdraw money. It might advise the bank to hold a little extra cash during busy times, or adjust interest rates to encourage people to keep their money deposited. However, even the smartest computer can't fully control human emotions. If a single piece of bad news or a damaging rumor spreads, fear might overcome logic, leading everyone to rush to the bank regardless of what the AI predicted. Central banks like the Federal Reserve in the United States act as a safety net for this system. They are the lenders of last resort who step in to provide extra cash to banks if there's a risk of a bank run. Imagine a central bank as a giant candy warehouse that can supply extra candies when a local candy jar starts running low. While this emergency help can stabilize the situation temporarily, it relies on the overall trust of the people. If everyone stops trusting the bank, even a central bank's intervention might not be enough to calm the panic. So why does all of this matter to you? Banks aren't just places where you store your money. They are essential for keeping our entire economy running smoothly. When you deposit money in a bank, you're not only keeping it safe, you're also helping the bank lend money to others. This lending process enables people to buy homes, start businesses, and invest in their futures. In return, banks pay you a little bit of interest, which helps your money grow over time. Without this system, the economy would slow down, and everyday transactions would become much more complicated. Every day, millions of people interact with this system without even thinking about it. When you use your checking account to buy groceries or transfer money with your phone, you're participating in a carefully balanced system of trust and finance. The idea is simple. Banks hold only a fraction of the deposits in cash and use the rest to fuel economic growth. As long as everyone continues to trust that they can get their money when needed, the system works smoothly. Looking ahead, there's hope that technology will make the banking system even more robust. Advanced AI could monitor spending habits, economic trends, and even social media chatter to predict when banks might need extra cash on hand. This could help banks adjust their cash reserves in real time, reducing the risk of a bank run. However, no matter how advanced technology becomes, it can't entirely eliminate the unpredictable nature of human behavior. A single rumor or moment of panic can still trigger a bank run. There's also a growing trend toward digital money. More people are using online banking, mobile payments, and even digital currencies like Bitcoin. Digital currencies often operate without a central bank, relying instead on decentralized networks of computers to manage transactions. While this offers a new way to manage money, it doesn't completely solve the problem. If too many people decide to convert their digital assets into cash at once, a situation similar to a bank run could occur, even in the digital world. At its core, the reason banks can't handle everyone withdrawing their money at once is simple. Banks aren't holding every dollar as cash. They're using most of that money to lend out and invest, which is what helps the economy grow. The entire system is built on trust. The trust that you won't need your full deposit all at once, and the trust that the bank has enough cash available for everyday needs. When that trust is broken, even for a moment, it can lead to a situation where the bank doesn't have enough cash to meet everyone's demands. In summary, banks operate on the principle of fractional reserve banking. This means they only keep a fraction of deposits in cash while lending out the rest to drive economic growth. The system relies heavily on trust, careful cash management, and safeguards like deposit insurance and central bank support. While technology and AI may improve the stability of the system in the future, human emotions and the potential for panic will always be factors that can challenge even the most advanced systems. So next time you check your bank account or use your debit card, remember that behind the scenes, there's a delicate balance at work. Your money is part of a larger system that depends on mutual trust and careful planning. And while a super smart AI might one day help manage that balance even better, it's the collective faith of everyone involved that truly keeps the system stable. Thanks for watching! Don't forget to like, subscribe, and drop your questions in the comments. See you next time on Explain Like I'm 5.